Are you tired of guessing your trades? For most traders, gaps are just confusing holes on a chart that might close someday. No clear rules, no direction, just randomness. But what if I told you gaps are half the reason the market moves? Ready to see the market through the lens of a pro? Let's jump in, and by the end of this video, you'll never look at a chart the same way again. Let's go. Friends, I know that many traders have a very superficial understanding of how to use gaps in their trading. For most of them, it is just some element in the price, which should overlap there sometime, and you cannot rely on this element at all. This is all natural, as you don't have clear patterns and characteristics of how gaps should be handled and how they should be applied on a consistent basis in shaping the context and immediate trade. With this video, I want to close all these blind spots for each of you, as gaps are exactly half of understanding price behavior. In this video, you will learn how to read the market with the help of the gap matrix. What is the gap matrix? How to use gaps to determine the direction of further market movement. How to understand in which gap the price becomes and which gap is forgotten. How to form a systematic approach to reading gaps. And what are the techniques of capitalizing movements with the help of gaps? When you realize what I will show you today and tell you, your trading will change radically, because this is the very essence of the market and you will learn a lot about it today. So let's get to the main part. I would like to say that if this is the first time you came to this video, to my channel, and you are not very familiar with gaps, I recommend you to watch the first video on my channel first. I will leave a link to it in the description of this video. First watch it, lay the foundation, and then come back here, because I'm going to say more advanced things here. So you can watch this video. It will seem so incomprehensible to you, but the one who will understand, or who already understands gaps, this information that I am going to show and tell you now will be perfect for him. That is the story. I have prepared a lot of interesting points for you, and we will start from the base. We will talk about some things. That is, I consider 3 variants of gaps in gaps. There may be some other variants, but today we are going to talk about 3 standard gaps. And the first gap is a fair value gap. We have such a story that is, roughly speaking, yes, a standard thing. We have the first candle, we have the second candle, we have the third candle, and in the combination of these 3 candles, the first and the third do not touch. That is, we do not have an actual price gap here, yes, but just active trading, that is active price growth. And there were not enough sell orders in this zone. So we have a certain market inefficiency, or imbalance in another way, or fair value gap, or just a gap. Yes, that is, this thing is the most standard, the most common story, and we will use it as a basis. And the standard theory, standard information says that this gap will have to be rebalanced at a certain time. No one ever says what time. That is, I will share my findings with you. How to take this into account on a systematic basis, and how to use it in your trading so that you can understand that yes, this gap, this particular gap, will be rebalanced. They will not go further. They will stop. They will find some support there and move on. So there is a certain logic in it, because if you realize that there are gaps, yes, for example, there is a gap here, there is a gap here, there is a gap here, and there are 150 more gaps. You mark them all. It does not give you any absolute information. That is, you kind of see after the fact, yes, there was a gap there, the price may go there, or it may not go there. That is, you do not have clear instructions. Today you will have them. So the first gap that we will use and that we will discuss is the fair value gap. This is the standard. The next gap that we will talk about is volume imbalance, i.e., where we have it here, this gap, you see, I usually highlight it in black color to understand. So we have this one, this candle and this small candle. They touch each other only by shadows. That is, roughly speaking, shadows. They represent the shadows of candles. They represent the smallest volume within a particular candle, and accordingly at this moment there is just a touch by shadows. That is, if you look at all candles, it closed here, it opened here, it closed here, but there is also volume imbalance here. I usually do it like this. I stretch the chart wide, And you can see very well these zones in this thing. It is formed less often, that is, it is 10 times less than the usual gaps, but its importance is greater, that is, this point. It gives very powerful dynamics, that is, it magnetizes faster and reacts more often. That is, it is also a certain pointer, which we will further integrate into the general understanding. I call it the gap matrix. That is, when you see what I will show you, yes, again, it will happen not immediately. I will not tell you all the information in this video, of course, because there are things that you have to keep to yourself because they are too cool. Here, but the very essence, that is, I have an analogy with the movie Matrix, yes. That is when, remember, when the dispatcher looks at the screen and sees just green numbers, and he says, I see not numbers, but I see a matrix. And this is the story of gaps. That is when you learn and catch the essence, where, how, and under what conditions to look. Of course, I will share a lot with you today, and it will help you a lot. And when you will be able to see through the prism of what I will show you, even partially, you will learn to read the matrix of gaps, because I am constantly in my videos talking about gaps. This is 50% of the reason why the price moves. The other 50% is liquidity. But about liquidity, I will also soon make a cool video more extended about manipulation and so on. That is, when it works in combination. You read the market, you see the reasons why it goes. Actually, not just some speculation from the price. There should do this and move actually. The first gap is the fair value gap. This is the volume imbalance. That is when two candles touch each other only by their shadows. This is the second gap, which we will use in our system today. And the third gap is that we have here void liquidity. That is, when there was no liquidity at all, that is, there was such an intense movement that a candle opened here and then it moved on. That is, it happens most often on some news or there at the opening of the session. Yes, that is, something here was on the news, most likely. You see, that is 1530, the price went down, then went up, and this is 1700 opening of New York, and the price flew with a very large gap. And this point will also have a very powerful influence. Again, it will be formed even more rarely, and there are certain conditions which I will talk about further. But again, we will also use this in our coordinate grid, in the grid, or rather in the matrix of gaps. And when all these things are in place and you learn to notice these things first of all, because all these things are on the charts. What I'm going to tell you today is on the charts. You just haven't looked there, you haven't noticed, your eyesight is not trained. And today I am going to give you specific reference points that are designed to bring more awareness to your trading, that is to make more sense of what you are doing. So to begin with, we are going to use three gaps like this. You need to understand it, you need to see it. So moving on, and the next classification that will help us in understanding the contextual position of the gaps. That is what goes where, how, why. These are two matrices of gaps. The first is the strategic matrix, and the second is the tactical matrix. So based on the name, strategic is something larger, large scale, and tactical is something more localized. And you should realize that markets are fractal. That is, everything starts from the senior time frames and fractally, i.e. in the same patterns, positions in certain zones is formed on the junior time frames. Well, one very important thing you need to understand, the large cap, the smart money that we keep talking about, it doesn't trade on M15. He doesn't trade on M5. He doesn't even trade on H1. So he trades the monthly time frame, the weekly time frame, and the daily time frame. So the daily is like M5 for him. And this is the story. Accordingly, the higher the time frame we have, the more we can understand the logic of the movement. That is, again, what I show you, I mostly show you on indices. That is, it all applies to gold, Bitcoin, forex, and the euro pound. It's all applicable, just everywhere there are peculiarities. And not to go into all the nuances of how it applies to each individual currency pairs, because this information is not for free videos on YouTube. This is the system element. I am showing you everything on the example of an index. And here you see a section in front of you, and this is a daily time frame. So here you can see, yes, I have put this indicator D. So this is the daily time frame. And here's the story. I want to consider this piece of price, a specific example. Naturally, I will show everything on concrete examples so that you can understand it a little bit at a time, a piece at a time, a puzzle at a time. And then you will be able to use what I will tell you and show you to apply it holistically to other markets or to the same indices. It makes no difference. So what is the logic here? We are now talking about a strategic matrix. So this is such a movement for overlapping gaps. Yes, that is for rebalancing gaps, which affects the senior time frame, starting with the monthly, weekly, and daily time frame. Again, it might be a little bit different for different instruments. So somewhere it could be H4D1 weekly, somewhere there D1 weekly, monthly. So here, specifically, what I'm showing you is a daily time frame. And here we have a gap. And the price came, strictly overlapped this gap, hit the rejection block here, and went on. It moved on. That is the reason why it moved here. Yes, the price reached certain goals here. We need a certain context of understanding, but the very essence, the price started to go down. If you look at this gap, it is in front of a certain barrier. That is, I will again say, why the price stopped somewhere, but the logic is that on the daily time frame, the price came here. After this touch, it moved up. So if you see that the price has moved up, it means that the price has moved up. If you look from here, yes, from this movement to the top, we have only two gaps here. That is, we have a gap here and a second gap here, and then the next gap is formed within this downward movement. If we look at the weekly time frame at the same section, it is this candle. That is, in fact, we had one big fat gap here. The price completely covered it, went even a little lower, and we used the daily time frame just for detailing. That is, we can't just predict that the price will not reach anywhere. Yes, or it will stop there somewhere. That is, we need to clearly understand the reasons why the price will not go further. Again, we will talk about this further. But here is what I want to show you. That is, there were two movements here. One was descending to the gap, the second one descending to this gap, and then further down to some targets. So this downward movement and upward movement is a strategic matrix. That is, within this downward movement, now we will see it, and within the upward movement, there were tactical matrices. That is, roughly speaking, if we present it in a more simplified way, then the strategic matrix is movement within the framework of older time frames, some older ones. And tactical is within some more local time frames like H1, M30, M15, and so on. And the logic of what, if you know that the gap will be rebalanced and you see there on the lower time frames that the price has started to descend, somehow broke through the structure no matter what you use. Naturally, you can use different tools, but let's say you use some breakthroughs of the structure and so on, and you see that the direction of movement has potentially changed, and you wonder where the price will go, and you look at what kind of unbalanced gaps we have, because gaps are mainly used for rebalancing, and it's like this daily gap and this weekly gap. The daily gap, it details the weekly time frame. This is the main target of the movement. So there could be some more gaps here if there was no rejacking block here. And so the price came right here and left. So this is our strategic matrix. Now, if we go to the 4-hour time frame, we see here two more gaps, which were tactical. That is, the price has rebalanced two such market inefficiencies along the way to this gap of the senior time frame. This is H4. Again, different time frames are overlapping and detailing each other, and we have a certain fractal understanding of the price. That is, when we combine different time frames, we have a more complete picture. If we switch to the hourly time frame, we can see more gaps. Here's H1. Here is this H1. Here is this H1. Here is this H1. Here is this H1. Here is also H1. These are all tactical gaps within the strategic rebalancing of the senior time frame. That is, even this idea itself is simple. I may have made it sound complicated for some people, but again, with my skills to simplify, I couldn't make it any simpler. So you have to mention certain details. So you see globally where the price can rebalance. And you realize, yes, we have a downward correction. And within the framework of this correction, you're looking at tactical gaps. That is, you have a certain coordinate plane. That is, you understand, where we are moving on the senior time frames, because you have an understanding of what gaps can be rebalanced there. And you have a tactical application of these gaps. That is, you are not just there on the daily or weekly somewhere to sell. Yes, that is, you are interested to see how it is confirmed. And what is the history here? I mean, for example, you saw a gap here. Price did not renew the high, broke through the boom structure. Another gap was formed. Everything. That is, you can already enter at this moment. Why? Because the price is not updated, the structure has been broken, another gap has been formed, and you have a strategic move here to rebalance the older time frame of the gap. That's it, you're in, and you can take your profit. Again, this is H1. The price came here again. Here, well, look, here we have a gap, then we have a small gap. The price did not reach there, then it went lower, came here. This gap rebalanced. It went lower again. It came to 101. And again came to this final target. It touched the rejection block and moved somewhere else. And again, we will see what the history was here, yes. Again, we have, well, let's focus on it now. Let's move further. And you understand the logic, yes. You use the senior time frames. That is, in order to understand where the price is moving, you need to look at the senior time frames. Again, depending on the currency pair on which you trade, or there are tools that you use, for example, there on the weekly time frame, you will not see gaps at all, and on the daily will not be visible. And look, where the gaps are self-significant, I mean, it's somewhere, well, not below H4 and H1. Anything below that is already some local rebalancing, so you can get confused there. What's the point? To understand where the price is moving. And these two matrices, strategic and tactical, if you keep that in your head and try to find the answers to these questions, where's the tactical matrix? Where's the strategic matrix first? And where is the tactical matrix? Then you automatically form the context and you don't act like a blind kitten. You just go randomly up, down, up, down. So you're asking specific questions and you try to get specific answers. And when you get some specific answers, you realize that yes, there is a higher probability there. And you're already working in that probability instead of the other approach. When you see 150 grapes, they're going somewhere, it's unclear. And when you do it in this format, even though it seems simple, yeah, it's like, what's there to do? Well, it's nothing new. You could say that. But the devil is in the details, and mastery lies in simplicity. It takes a certain amount of experience, a certain amount of skill to put it into such a simple shell, and to squeeze it into such an easy format. But again, this is only the very beginning of what we will discuss with you. So you understand the logic, right? You need to understand the strategic movement from where and to where, and tactical movement on smaller time frames. And then we will talk about where the price is. I will not reveal everything to you, let's say the stopping points, where the price can slow down and find support, but I will reveal some things to you so you can already use it. That's the story. If you start using it, you will grow very, very much in your understanding of gaps.